So this is trading A to Z. The idea is that you can go from having zero experience, you don't know how to do market analysis, you've never been on the charts before, and by the end, you can do all the market analysis, you got a trading account set up, and you're ready to place your own trades. So the first thing that anyone needs to do that wants to start trading is actually creating your own trading account. You'll be given a MetaTrader 4 or a MetaTrader 5 password. This is given to you by a broker. So the first steps will be going onto the brokerage, creating your trading account there, and funding your own trading account. The broker then gives you these MT4 details, and the MetaTrader 4 app is what you use to place your own trades. It is very important to note that you only want to go with a brokerage that is FCA regulated. That means that, in the event that the brokerage does go bust, your money is safe. So if you want to be in a position where you're analysing the market and you're placing your own trades, you need to have somewhere to do it. In my view, TradingView is the best place to do all of your market analysis. You can do pretty much everything you need here. On here, you can change the currency, you can change the time frame, you've got indicators, you can buy and sell all on this, so you can connect your MT4 account through your brokerage onto TradingView and place trades directly on the charts. Using different strategies, different indicators can help. You can have, different moving averages, you can have the time zones, which helps, you can have the smart money concepts. Pretty much everything that you can imagine can be found on TradingView, and it's the best place to analyze the market 100%. So when you first sit down on TradingView and you're looking at the charts, you're just going to see a lot of candles, and it's probably not going to mean much to you. So the first two things that we need to realize is that bullish means that the price is going up, like these blue candles, and bearish means that the price is decreasing, as shown by these black candles here. So what does the candle actually represent? The top of the wick in a bullish candle, when the price is increasing, the top of the wick is the highest that price has reached in the time period. The top of the body of the bullish candle is where the price closed at the end of the time period. The bottom of the bullish candle is where it opened, and similar at the top, the bottom is the lowest point reached during that time period. And it is exactly the opposite for a bearish candle, as what I've shown here. When you load up TradingView, your bullish candles will be green and your bearish candles will be red. I've just changed mine, but it has no effect. Top of the wick is the highest point, bottom of the wick the lowest point. For a bearish candle, it's slightly different. The top of the body represents where the candle opens at the start of the time frame, and the bottom is where it closes at the end of the time frame. The first concept that we're going to talk about is fair value gaps. Very, very simple, but very widely used and very popular in the trading space. All it is a 3-candle formation, and it's a gap between the third candle, the bottom of that wick, and the first candle, the top of that wick. So this area here, but what does that really mean? So all that this is showing is that there's displacement in the market, and there's in this case a very big bullish push, and that the bullish price is going towards another area of liquidity. And it's exactly the same for the bearish example here. Price is surging down and searching for an area of liquidity that's potentially lower down on the market. So a little bit more about fair value gaps and what do they actually mean and what do they do. So what will happen is, in this example, we've got a big bearish push that's created, 2 fair value gaps. Price will revisit this. There's often liquidity in these fair value gaps. So price is always moving towards some sort of liquidity. It surged up, it's went back, filled the inefficiency left by the fair value gap, and it is now continuing its surge for a higher price. So as it's going up, price will retrace back into the fair value gap, pick up the liquidity, fill in the inefficiency, and use this as momentum to fuel the bullish push. It's exactly the same in the bearish example. What I wanted to highlight here is that once a fair value gap has been filled and once price has revisited it, it's then invalid, which means, like shown in this example, the second time that price comes and touches the fair value gap, it won't have the same effect. Not that every single fair value gap will be respected, and not it doesn't happen like this every single time. Point being, once it's already been fulfilled, the price has already revisited that area, we can kind of not think about that fair value gap anymore, but can kind of just ignore it. The point of me telling you about these fair value gaps is that they are really useful to use as an entry. but not on its own, would use this as a confluence. What I mean by confluence is just when you stack multiple things that are telling you that our price is either bullish or bearish, and then you take an entry based on the confluence that you have in front of you. So continuing on this, what we want to do, we only want to place with trades and place with entries on fair value gaps that are high probability. So which ones are likely to react to the price? So in this example, we've got a big bullish push, We've got fair value gaps on the way up. The first formed fair value gaps are always the highest probability to react. And we never want to place trades in the top half of this move. So let's say this is the full move. You got the bottom here, you got the top here. We don't want to place trades in the top half. So we wouldn't enter off this one, for example. If you want to do this, properly on TradingView, you want to go to the Gann box tool, and this will basically help you visualize where exactly the half point is on a move. So you want to get the lowest point of a move, highest point of a move, get the Gann box tool out, and you can easily visualize where the top half is, where the bottom half is, and you don't want to place trades within that top half. That being said, that's only for a bullish move. For a bearish move and the price is decreasing, you don't want to take trades in the bottom half of fair value gaps in the bottom half. So to continue, another way to identify whether a fair value gap is a high probability or not is if it's had a break of structure. Now this, in simplest terms, mean that it's broken a previous high. So as we can see here, we had the previous high, we had equal highs 3 times where prices reacted at this level. What's happened is it just then broke through this structure line, and then it's formed 3 fair value gaps. Because of this big bullish move, it indicates to me and all the other traders on the market that these are much more high probability than this one, even though that one is in the bottom half of the move. In this case, we'll have a level of resistance. So similar to this example, we've got price has reacted to this and it's not been able to break through. When it has broke through, there's been a fair value gap formed on this line of resistance. So when price revisits this area, this fair value gap and this level of resistance, we have 2 confluences telling us that price is going to react. Price has reacted at this level twice before. Once it's broke through, it'll become a support level. This means that when price revisits this level, it'll most likely react and go in the bullish direction. So the first confluence is that there's a level of support. Second confluence is that there's a fair value gap which is aligned perfectly. So there's 2 things that are telling us once price revisits this, we'll get a big bullish move. So another way to tell if a fair value gap is valid or not is that when price revisits, how does it act? So in this example, we've got a fair value gap in the bearish direction, and it's being completely disrespected. What I mean by disrespected is that the candle is closed well above this fair value gap. This is basically the market totally ignoring it and saying, no, we don't think that we're going to continue this bearish move. We're going to be in a bullish direction. We'll talk about this later because this is an inverted fair value gap. So this is something that we wouldn't enter upon. This, however, is a really perfect example. Got the fair value gap here. The candle is wicked in on 2 occasions and then came back out and continued this bullish move. It's also okay if the candle finishes inside of the fair value gap. The only problem is if the candle finishes below in the bullish example or above in the bearish example. So probably the biggest and most important concept that you're ever going to learn in trading is liquidity. So if you can take one thing away from this, and that's the only thing you can take away, what I'd say to you is that price is always moving towards some sort of liquidity. So if we can work out, which liquidity that the price is heading towards, we're going to be profitable, and that's as simple as that. 2 types of liquidity we've got: internal and external range liquidity. This is just a posh way of saying external is old highs and lows, and internal is going to be the fair value gaps. Liquidity, in the simplest terms, is basically where money is in the market. So in this example, we've got a high, and sellers might have placed a sell here. They've shorted the market. When the price retraces and comes back, we know that there's going to be lots and lots of stop losses above this high. So we know that price is surging up towards this external range liquidity or the old high, because that's where stop losses are going to be, because that's what the market makers are pushing the price towards to fuel that either bullish or bearish reaction. So the question is, how do we use this to actually enter trades? So in this example, got a fair value gap and all the requirements have been met that we've just spoke about. So it's in the bottom half because it's bullish. It's not been revisited before. it lines up with all support and resistance levels. We know that price here has just hit an internal range of liquidity. So therefore, it's going to be striving towards an external range of liquidity, so an old high and an old low, as I've marked out here. That's where we place we take profit, because we think that price is going to continue the bullish push and travel towards this old high as it has. In terms of placing your stop loss, what you want to do is basically place it at the point that would indicate a total disrespect of the fair value gap or a change of character within the market. This is a fairly textbook trade, as we never really went into drawdown. Drawdown being when you trade with a loss. We've just had a big push, and it's went and smashed the take profit fairly quickly. Very nice. So I want to clarify a little bit more as to what I meant about liquidity. So it's basically just how easy an asset can be bought or sold. I spoke about market makers previously before. That's just institutions who are trading with hundreds of millions. So you've got banks, investment firms, and they basically have the power and the money to manipulate the market. So, they might want to buy £100 million, for example, worth of gold, let's just say. But they don't want to buy it at a premium, at a high price. What they want to do is drive the price down so that they can actually, fulfill that order. They might not, in this example, in the middle, we're not at a high, we're not at a low. In the middle, they might not have the ability to actually buy £100 million. What they want to do is drag the price right down. We know that there's liquidity below here, so they've went down, clicked the liquidity, and fueled this bullish push. So this is a few examples of liquidity. We've got a fair value gap here, that's bearish. We've got a low here, so we know that the stop losses are below here. We'll also have something called order block, which is basically the last down close candle before a bullish push, or the last up close candle before a bearish push, but we'll come on to that a little bit later. So following on from the previous slide, always want to enter trades when with stack confluences. One of the best way to stack confluences is entering trades after market has swept liquidity. Sweeping liquidity just means it's picked up liquidity within the market, and it now is fueling that as momentum to go in its original direction. So, as you can see here, fair value gap has been created, bearish, gets revisited. We've entered this trade because all the requirements are being met for this fair value gap to be valid. What's happening here is the price is picking up the liquidity left behind at this fair value gap, using it to fuel its bearish push. So it would enter, take profit at the previous high. Stop loss up here at the point that would indicate a change of character in the market, or the fair value gap being disrespected. So, staying on the concept of fair value gaps, I'm waffling on about it because they are so big and they are so important and they can make you so much money. This is basically when a fair value gap is being immediately disrespected and the body of the candle closes above in the bearish example or below in the bullish example. As we can see here, would expect price to continue this bearish push, potentially be revisited, and then use that as momentum. However, prices basically totally ignored that, had a really big bullish push in this big candle, and then continued in the bullish direction. We can enter trades off the back of IFVGs. They are very, very high probability as long as we've stacked them with other confluences. So, as you can see, we've got a resistance level here, and we've got equal highs. Prices visited at 1, 2, 3, nearly 4 times, which shows this is a really strong level of resistance. We know that there's lots and lots of stop losses above here, so we know that there's a lot of liquidity here. Had a liquidity sweep, then immediately we've had an inverted fair value gap. So not only have we swept our liquidity, we've got a big indicator that the market is changing direction. So we would 100% take a trade here. In this case, obviously, it went very, very well. So the only really difficult thing about this is knowing where to place your take profit and stop loss. Anyone can say that, right, we've had a liquidity sweep, right, we've had an inverted fair value gap. We know that the price is now bearish, but where do I place my take profit and stop loss? As for the stop loss, we'll go at this high, because if price does retrace and go higher than this, the chances are the market isn't going to be bearish anymore. So having the stop loss any higher is basically just wasting money and we're going to lose. Take profits, it's quite subjective. So what we could do is go for this, swing low here. We could go for this order block here. But because in this example, we had such a strong indication, we had a really strong fair value gap, we had a liquidity sweep of equal highs on the resistance level, what I've done is aim for this order block right down here, because I thought the market was really, really bearish. So a little bit more about order blocks. A very simple concept. It's basically the last up close candle before a really, really comprehensive movement within the market. Up close in the bearish example, down close in the bullish example. So what do we use this for? Future level of resistance / support. Basically, when price revisits it, we know that the price is going to react. Well, we think that price is going to react again and give way another, in the example, bearish push. So why do order blocks actually form and why did it occur? So in this example, we're going to really big bearish push, and that's because sellers think price is really, really high. So price is a premium, essentially. So when price gets to this point, all the sellers think, right, this is the really, really high point for the market. We think it's going to go down, and so it shoots right the way down. And that's why it does become a level of resistance, because when price reaches this again, we think, yeah, we know this point in the market is a premium, so we're going to sell again. So it's really, really good entering trades off. So to continue, what we're going to see is that we've got an order block here, which is a huge, huge push. And what's happened again is on, see if this is in the minute time frame, 2-3 hours later, it's revisited this point and had a big reaction again because price, in this case, in the bullish example, is at a discount. So all the buyers want to get in on it. So we can take trades, for example, positions like this, an inverted fair value gap. That's a good within this bearish order block. And what we'll do, position with stop loss at the top of the order block. If it goes any higher than that, it means that, price is like totally ignored the order block, and we're looking at a big bullish push in this example, and we'll take profit down at this swing low down here, as we know that price has previously hit that. So that's what we're expecting to happen again after we have the indicator of the inverted fair value gap. As I mentioned before, it's like a broken record, but this is one of the things that we're going to use as a confluence. We can't just enter it on its own. For example, we would have been okay here, but in it here, but at that point you're just guessing if you're just using one confluence. It has reacted twice before, so on the third example we're thinking, right, it's happened twice before, it's more likely to happen again. We just need an indicator, in this case a really, really strong double inverted fair value gap that were immediately disrespected by this bearish candle. So we're taking entry off here, we'll have it on the swing low, and we'll have the stop loss above the order block. Really, really nice example because of how often this happens in the market. We'll talk a little bit about top-down analysis later on, but if you go through the time frames and you mark out where your order blocks are, you'll see that time and time again, the market will react to these positions. All you need is a lower time frame indicator like an inverted fair value gap to actually enter from this. This isn't the best example in terms of risk to reward, but this is at least a 1-to-1, so we'll talk a little bit more about risk management as well. But point being, even if you only win 50% of your trades and you've got, more than a 1-to-1 risk to reward ratio, you are going to be a profitable trader. That's how easy it is. A similar thing is a breaker block. Basically, it's when price is disrespected, as we've spoken before, disrespected this order block. So price has had a big bearish push from this order block here, and then the price has risen back up, thought about coming back down, but then price has totally ignored it and pushed straight through. This is what we call a breaker block, and it's not a valid order block, as we've had a change and break of structure. So this is where a really, really, really strong entry model is formed. So what we'll have is a low, a high, a low, a low, high, high, and then basically what's formed in this big bullish push, we've got a fair value gap. Got the breaker block here. It's being disrespected, as we can see. In this zone here is what we'll call a unicorn zone. So what's happened is price just came back down, revisited this fair value gap, filling that inefficiency, and fueled it for a big, big bullish move. To spot this in the market, all you need to see is two break of structures and a fair value gap being formed. Simple as that. So we can visualize it here a little bit better. We've got the unicorn zone here in the purple. Where we'd enter is at the top of this zone. So when price retraces back and hits that point, we'd take an entry. What's very, very important, and basically the most key thing that people might miss, is that on the second break of structure, you need the candle to close above the order block. If it doesn't, it's not a valid break of structure, it's not a valid unicorn zone, and your probability of your trade being successful is much, much less. So as we can see here, we've got the order block in this example. We've got a bearish example. Order block here, very nice. We've got the fair value gap here, very nice. Got the first break of structure here, got the second break of structure here, order block, fair value gap. We enter at the very, very bottom of the zone in the bearish example, top of the zone bullish example, and prices went back, filled in the inefficiency left by the fair value gap, and used it to fuel its bearish push. Very, very good. I love this model. It works so much of the time. What we'll do, we'll take profit at the next area of liquidity. You can't really see this, but that was order block here, and put the stop loss at this high here. The reason we put the stop loss here is that if price does actually go any higher than that, we know to write it off because it's had a total change of direction again, and it's broken structure again. So we're at a loss. This is probably the most common model that I used out of everything. It combines a couple of confluences before you even do anything. So what I'm going to talk about next is how you add a few more things to it, such as an order block, to make it even more likely. So we're going to set our confluences, and in this case, we've got another order block down here. What we've had, very, very hard to see, but price has just wicked into this order block. That's basically telling us that it's going to have a really, really big bullish push. So what I'll be looking for is another confluence. In this case, we'll have a unicorn model. So like before, we've got low, high, break of structure, low, break of structure. The candle's finished above that previous high. So we'll enter right at this point here. Price fills in the fair value gap. There's two actually here. And we'll get a big, big bullish move, and we'll take profit fairly easily. So the next thing which I'll talk about is daily bias, and this is something that you can use to stack your confluences. In simplest terms, it's what direction do we think the next daily candle is going to close. Use this as a confluence that's really, really strong if we did in the 1 hour or 30-minute time frames. I would not use this as a confluence for your 5-minute or 1-minute time frames, however. In order to work out the daily bias, we'll just do analysis like any other. We'll just like its lower time frame analysis. We'll come back to the point that price is always moving between IRL or ARL, different types of liquidity. So all we'll do, hop on the daily chart and basically work out what direction the candle's going to head. Really, really key thing that we're going to look out for is engulfing candles. So in the bullish example, this candle body engulfs the full of this candle and the top of the wick. Bearish example engulfs the full candle and the bottom of the wick. This basically is an indicator that price is in a strong bullish or strong bearish market. So what we've got here is an order block. So we know that there's liquidity there. On the right hand side, we've got an engulfing candle right here. You can't see, but that's a black candle, bearish. So we're going to put two things together. We know that price is probably going to be bullish because of the engulfing candle, but we don't want to use that alone. So what we use with it, we use a sweep of the order block to go right. It's so likely that the next candle is going to be blue. It's going to be bullish. So then we can take longs of whatever currency pair we're on. So top-down analysis. This, like so many things in trading, people try to make it, complex. It's not. It's basically you go through your time frames starting from the daily. You work out where the areas of liquidity are. So I'm on the daily time frame, for example. I go, right, is there any fair value gaps haven't been fulfilled? Is there any order blocks? Where are the significant highs and where are the significant lows? I then go to 4 hour, rinse and repeat, 1 hour, 15 minute, and then down to your time frame of whatever you choose. If you trade in the 5-minute time frame, by the time you get down there, you've done a daily, you've done a 4 hour, you've done a 1 hour, you've done 50 minutes. You've already done analysis on 4 time frames, so you know where all the liquidity is. So you can see, for example, if prices just hit an old low, price is so likely to go to an IRL as it's just hit an ERL. Stacking confluences across multiple time frames just increase the probability of your trades, and it means that your analysis is less superficial as if just going on one time frame. So your chart might end up looking like this. So I went out in the 5-minute time frame and I've basically marked out any areas of liquidity. So what I would probably have done is, for example, took an entry here. Why would I do that? 1, because it's on an order block. 2, it's on a fair value gap. So what I'm thinking is that price is now going to move towards external rest liquidity. So this dashed line here is an old low. So I would be taking a short here and then holding it all the way to this point here. This is something that literally anyone can do. It's not difficult at all. It's marking out any areas of liquidity and then coming out the lower time frames and saying, right, has it hit an internal or external range of liquidity? If it's external, it's going to internal. If it's internal, it's going to external. Simple as that, not complex whatsoever. Now onto the risk management. This is boring, but it's something that you have to do if you want to be successful. You wouldn't believe how many times I say it, of someone who doubles their money in a week and then blows it the week after, because if you're doubling your money, you're over leveraging, and that's just the top and bottom of it. What we've got here is a lot size calculator, which I've linked, which you'll all be able to download this anyway. You can basically put in currency pair, how much is in your account, how much you'd like to risk, and your stop loss. So let's say you want to put 5% risk, which I wouldn't recommend because in 20 trades it'd blow your account. Everyone generally does 1 to 3%. You put in your risk, you put in your currency pair, stop loss, etc., etc. Your stop loss you can find on TradingView. Contract size, you can find that on, well, it'll auto-fill it normally. You can find that on MetaTrader 4 if you go in the details section of any currency pair. And this basically tells you what your lot size should be based on your stop loss. So let's say you had $1,000 account, you want to risk 5%. You put in your stop loss, and that means that if you hit your stop loss, you'll lose $50. When we're talking about risk to reward, 1 to 2 risk to reward would mean that on this trade, for example, if you're risking $50, if you hit the take profit, you're going to make $100. That's why when I said before, if you got a 51% win rate, but you've got a 1-to-1 risk to reward, you're going to be profitable, even though you're not doing crazy trades and you're only winning 51% of them. So before you do get started, a few things that I would recommend is backtesting your strategy and trading on the demo account. So on TradingView, what you can do is basically do a bar replay. You can go back and replay what's happened in the past, and you can see where you can get your entries. You can do your analysis and then take trades and see whether you would have won them or not. When you've done that, and you're confident that you can, take trades and win them, you can then go and trade on demo. So you can get a demo account on MT4 or MT5 dead easily. They'll just fund your account with basic credit of 100,000 or 10,000 or whatever you want to play with. You can place trades and then see how you do. Another boring thing that I would highly recommend you do is journal your trades. So what you want to do is say, right, these are my currency pairs I've traded. This is the stop loss. This is my win rate. This is me, all that information that you can. And now what that allows you to do is just visualize your performance. You can notice patterns, where you might be going wrong, what you're doing well with, what works for you, what doesn't work for you. And then you can tweak, what you do on the market to basically make yourself a more profitable trader. So what do we do as a trading company? First thing we do, we've got daily scalping signals. We give our group between 2 and 5 gold trades using support and resistance and some of the different concepts that we've spoke about today. And we've got a really, really exceptional win rate of 93%. Got lads making huge, huge money. We also have an auto copier. So what I recommend to literally everyone is that they do a little bit of both. If you jump on the auto copier, it'll take over and it'll do you nice money. However, if you can jump on the signals whenever you get a chance, bear in mind we put on 5, but I don't expect you to be able to put on 5 trades today and sat by your phone or sat on the charts like I am. So you just put on the signals whenever you can, and the auto copy will take your account over. The third and 100% most valuable thing is the one-to-one mentorship. Everyone in our group has complete access to one of our experts. So if you want to put on trades, or you're not sure why a trade's lost, or you want to know if you've set your confluences right, or you've done your top-down analysis right, you get direct access to me or someone else on the team, and we can basically walk you through or guide you in the right direction and tell you what you need to improve on, or what you're doing wrong, or what you're doing right. Anything you need, you come to us and we get the situation resolved. Best thing about it is that for all of this, there's no charge. The auto copy has a performance fee, but it's only the profit that we make it. All you got to do is be trading with us. You don't have to, do anything exceptional. There's no monthly fee. It's basically trade with us, make yourself money, and our broker sponsors us. So we're in a really nice position, and we can offer you all of this for free. So obviously, I can't give you all the information that I would like to in half an hour, 20 minutes, or whatever it's been. But if you could take a few things away from this, is that liquidity is where you're going to make your trades. Price is always moving towards some sort of liquidity. Work out which sort of liquidity that price is heading towards and place trades based off that. I've given you a few entry models, so you can enter off the unicorn model, you can enter off inverted fair value gaps, and you should be able to stack your confluences now to give yourself higher probability trades. If you would like to download this and you would like to get involved, by all means drop us a message. I'll be able to get you started. What my goal is to have a group of people who are all learning together, all earning together, and get you in a position where you're placing your trades off your own back. I'll guide you through it, I'll help you through it, but my goal is to have a group full of people who are all smashing it together, and we'll have a community of people who are discussing the markets and discussing, the best entries to take, different thoughts on different currency pairs.